talk about markets and areas to look for opportunity with Nitin Dharmawat, who's joining us from Aurum Capital. Nitin, you always bring something very differentiated to discuss on the table. So let's talk about the market scenario now. We are in November. We already kind of outperformed as far as global markets are concerned on a year till date basis, but it appears some of it is mean reverting. Today you bring a point that why the next year, which is the next calendar year, which is starting in almost 1.5 months from now, people have to be loaded before that, because next year could be a very meaningful positive returns. You lose out on if you are not loaded in good stocks. Explain that point to us.
Good afternoon, Ajay. Yeah, absolutely. So the next year is actually the pre-election year. So which is starting just 1.5 months or 2 months from now, as you rightly said, which is the Lok Sabha election will be in 2024, as we all know. So the year before that, that is 2023, will be pre-election year. And when I analyzed 8 Lok Sabha election, pre-election years starting from 1991, what I found that market has never given negative returns during an election year, never. Except 2009. And it was also on the back of the financial crisis world over that we have seen. And just after 6 months, market completely recovered during that period also. And there are multiple reasons for that. Starting from 1991, when a lot of negativity was there, if some of those who were there investing during that period, market has given 27% return. Next year was 22. 1998 was 4%. 1999, a short-lived government, a lot of uncertainty was there. But despite that, 66% return. 2004 was bumper year, actually, 86% return. 2009 was minus 28%. But as I said, that it was on the back of financial crisis, and it got recovered again. It was minus 28%, but got recovered in next 6 months. And 2014 was 22%, and last was 2019. There we got a return of 6%. So on in all, always it was green at Sensex level or index level. So we need to be very clear about this. There can be geopolitical risk. There can be some local risk emanating. However, on a broader perspective, market tends to be cheering for Lok Sabha election or during pre-election year.
Fair point, Nitin, and it makes sense because perhaps there's so much of election-related spending which is happening this year. Perhaps our recovery from COVID lows is much more sturdier than many other countries across the world. Every agency in the world has acknowledged the quality of growth here in India is far superior than many other countries, and then the election-related spending which happens. So fair point, makes case. Let's see. Tell us furthermore, if that is your hypothesis, how are you running your own portfolios right now? Have you started deploying the residual or extra cash which you had on the side? Would you want to go in 2023 fully invested?
Absolutely. So there are some sectors which have not performed well during last 1.5 year, including infra and cement or auto ancillaries. This sector should be seen, and infra especially because if you see infra spending will come in big numbers during pre-election year. One. Second is a lot of backlog is there in terms of payment dues to the contractors, which will also get clear during this period. So we need to be a little clear about this. Infra can perform, and if infra is performing, cement can come along with it. Similarly, auto ancillaries, because auto entire sector was not doing well, as we discussed earlier, and auto ancillary sector has started showing some signs of recovery. So these are some of the sectors which will do well along with few more sectors. And of course, we need to be invested during this period.
Okay. Nitin, I want to scratch the point of auto ancillary a little more. The areas of the market which had not done a whole lot, areas of the auto anch space, tires and batteries have started doing well. If you look at the OEM, then you would see that CV space is doing extremely well, good commentary. Do you like any auto ancillary, CV related auto ancillary stocks?
Absolutely. So, not only tire or battery, but if we are talking about in general about auto sector, there can be two parts. One is, of course, as you said, commercial vehicle, and second one is the passenger vehicle. And within that also you can have four-wheeler and then two-wheeler. Within two-wheeler, there is a definite disruption which we can see. So we need to be a little careful. We need to see the companies which are supplying to EVs rather than being a part of that disruption story. So look at it from that perspective. It would be more helpful. And there are companies which are going to get benefited from this entire boom which is happening right now.
Okay, out of the spaces which have not done well, one of them is infra, and actually for the lack of many stocks out there beyond one IRB, Jay Kumar, now NCCs of the world, the smaller ones have started moving PNC. How are you playing the infra space, and also why do you feel it could be a dark horse, and how are you playing that space? What names do you have in your portfolio, if you can share?
So without going with the names, because that would not be right on my part because of the policies that we are having. What are the things that we can look in infra companies? One is that we need to look at the balance sheet strength of the companies, the execution strength of those companies, cash flows of those companies, order backlog that they are having. All these factors will combine together and will provide us the right companies within that space. And you rightly said that there are not too many companies. We can count them on fingers from infrastructure, especially after 2008-9 debacle that has happened. There are not too many companies which are surviving, and they've done reasonably well during this period after that debacle that has happened.
Right. What else are you researching, Nitin, these days? I know your, the style of going into investing opportunities, finding any niche. The last time round we spoke, you found out national education policy related plays, small ones, they got re-rated. What else do you like right now? What are you researching as a new idea or theme?
So infra is one, as I shared. Capital goods is something that we have invested last year, and we continue to hold that, and they are doing quite well in terms of execution. Many companies have have given good results, and there is good commentary also. And as we are tracking at the ground level, these companies are doing quite well. Financials is another sector that we entered, and we continue to maintain our positive outlook on those companies, both private as well as PSU banks. Especially PSU banks, they have done really well, and we have taken big bets on PSU banks. So these are some of the sectors which we continue to like.
Right. What about your thoughts on the small cap end of the market? It's not very participative in this rally. We are almost at the cusp of new highs, but those stocks are quiet. Any thoughts there?
I'll give you another perspective about small cap. If you go back in the history and look at the period from 1974 to 1983, especially in US market, small cap index has outperformed large caps by a margin of 16% year on year. It's a big number, and why that has happened? It has happened on the back of very difficult time period. If you remember, oil shock has come, inflation was very high, Fed was increasing interest rate, and despite all this, factors, and wherein common thinking will say that quality companies or companies with significant valuations will continue to do well during the period. It has not happened that way. It is the small caps, good companies continue to outperform during that period, and something similar is getting witnessed now. We already seen that small cap has done very good rally during last almost 1.5 year, and now they are taking some risk. But I think small cap has a lot of steam remaining, wherein wherever there are good results and company has good management, they will continue to do well.
Right. All right, Nitin. Thanks very much for joining us on the show today.
Thank you.
Before we